Very good morning, everyone. Welcome to Tax Hacks 2020. We are here at the first workshop of helping you and hand-holding you on how to save maximum taxes and create wealth over a period of time. So I'm Pratibha Sharma from HDFC Securities, and we have Mr. Dipen Sheth. He's our head of strategy and marketing, and we have Mr. Kunal Sanghavi, who's our CFO. So over to you.
Yeah, hi and good morning. This is Dipen Sheth. I head the equity product and the strategic marketing function at HDFC Securities. Today we are assembled here thanks to Pratibha, and I would also like to welcome Kunal Sanghavi, our new CFO, to this session. It's a very important session for anybody who is making, spending and saving money today. And this is not going to be as glamorous as the ups and downs and the money multiplication possibilities that we get caught up with on the stock market in our normal securities avatar. This is a far less glamorous but far more important, or at least as equally important as equity investing. How do we save taxes and how do we create wealth in the long run? One part of long-term wealth creation is, of course, about investing in the stock markets, but an equally strong and a very potent lever that most people forget about is to be able to save taxes and to divert those savings from taxes into appropriate instruments and avenues that help you compound wealth and create wealth over the long term. What we'll do over the course of the next 30-40 minutes is that Kunal, who is more financially literate than all of us here put together because he's our CFO. So Kunal and I will be engaging in a conversation and walking you through a short presentation where we will examine this entire aspect of how do you save taxes, how do you create wealth with the money that you save when you save taxes in the medium to long term. And there, I think that this conversation will, by the time we are through with this conversation, you will all be pretty much clear about the way forward. A lot of us look at tax savings and tax saving instruments as things that we do only in March. But let me tell you, the Ides of March are upon us, to quote Shakespeare. And we need to beware the Ides of March. We need to make, it's not something that you do only in March. It's something that you should worry about, think about, plan for, not only across the year, but across your life. So I will now start the presentation, and the way we will run the presentation is that Kunal and I will pretty much run a conversation as we go forward. We want this to be as interactive as possible. I would welcome you to ask questions from time to time. There is a window from in which you can type your questions, and the moderator, Pratibha or Sham or whoever is conducting from the background will surely be sharing these questions with the rest of the audience and with me and Kunal. And we'll make an honest attempt to answer whatever questions we can answer. And that's how we'll run this webinar. So welcome again to Tax Hacks 2020. This is the first episode. We are going to have more than a dozen episodes between now and March, and we hope that you can attend as many of these episodes as possible. And maybe attending one or more such episode will make you more tax literate, more savings literate, and far more wealthy in the long term than you currently are. So with that, let me start the presentation. All right, here goes. So yeah, just a minute. I don't know if you can see the stuff. Yeah. So this is where we are. I hope this is visible to all. I'm into my first slide now. Pratibha, please confirm.
Yes.
Excellent. So typically all of us here in this webinar are makers of money. We have a business, we have a job, we have some or other occupation with which we make money. We spend money because we are consumers, right? And then we have goals with this money that we make, spend, and save. So we have money or financial goals, as they might be. Some of these goals are short term, which play out over 2, 3, 4, 5 years. I want to buy a car, I want to go on a vacation, I want to repay some debt that I had taken. I want to paint the house. I want that, big fridge now that I'm setting up a family, or whatever it might be, such things. But then there are medium-term goals. These are things that play out over half a decade to maybe a decade and a half, 7 to 15 years. These are just numbers. I'm sure most of you can relate to these things. So I want to buy a home for myself, or maybe I want to make a down payment on a home loan, at least start. There's a child I need to get educated in college or in university. I want to send him or her abroad. I want to do some education all over again. I want to get off the job for a couple of years and get into, I want to take a management degree or an engineering top-up degree, or my spouse wants to study and we need to shift to some other city where I may not have a job. I need some money to keep me going for a year and a half in that city, or whatever it might be. I want to have a second child. This assumes that the first child, had enough of your savings to make you feel safe about, and you don't feel so safe now that you want a second child. So there's a second or a medium-term goal associated with the second child. There is family support. All kinds of relatives and close relatives, could be parents, could be a cousin, could be a sibling, goes through some kind of stress, and you need to contribute to the family at that point. These things play out anywhere between 5, 6, 7 to 15 years after you start your job. Kunal, would you agree that these are the typical things that people are going through now, or you have a counter perspective here?
That's correct. In fact, a few of these things is something that people are boggling day in and day out, and they may not necessarily be very conscious about it. But when you kind of put it like this in front of everybody, they really that this is something that they are going in and day out. And maybe some may have 2 or 3 more things also in this. Listed is child's education, and nowadays that is becoming something very important. And so you must have seen government ends up coming up with a lot of such things. So that's correct.
Yeah. So these are unglamorous real life situations. None of these, we are a securities firm. We are in the stock market. None of this sounds glamorous and exciting, but this is the stuff that our real lives are made of. I'm not talking about, hey, we are going to blow up the secrets of how do you double your money every year in the stock markets. We are not playing into expectations like that here. We are not showing you money multiplier investment ideas here where you feel intelligent, glamorous and clever in the stock market. These are the nuts and bolts of life. Boss, मुझे घर खरीदना है, मुझे अपने बच्चे को पढ़ाना है, मुझे vacation पर जाना है. These are money requirements, and we all worry about these nuts and bolts of life on a daily basis. And family support. You don't know. Your brother's business went bust, and he needs money to be bailed out. Your sister needs family support because her spouse is not doing too well, and you can't back out at such a time, right? These are medium-term hassles for which we need to be prepared. None of this is as glamorous as the market, but let me tell you, it's all very real. It plays out in our lives daily, and just look around, look at your own life, look at your friends, and you will see this. Okay, so long term, which is like 15 years plus, a lot of the audience today, I'm told, is 30 years or younger. 15 years looks like a very long time to them. I can tell you, I'm 53. The last 15 years went by much, much faster than the 15 years before them. Once you get into life, once you get into a routine, once you get into a job, once you're in your late 20s, early 30s, time will just whiz past at lightning speed. 15 साल कहाँ निकलेंगे पता नहीं चलेगा, And hey, you know what? You'll actually be in a situation where you will be agonizing about your kids' marriage. Yes, a lot of my friends are doing that right now. Okay, you'll be worrying about a retirement corpus. मैंने कुछ एक nest egg बनाया है या नहीं, Do I have some money stashed away somewhere? Okay, these are the values that we've inherited from our dadas and dadis who accumulated over 10, 20, 30, 40, 50 years. Did they have a retirement corpus? Did they plan their retirement well enough? Should you not be thinking about that right now? Okay, maybe you want to retire at 45 and start up your own business. some fantastic new digital business model that you have, which you've got an idea for. Do you have capital to at least start it? Okay, so you'll get venture funding, but do you have basic capital and still have something to left, which is left over in case your business doesn't work out? And well, in the long term, we all want to live well. You know, I want to have a spacious home. I want to eat the best stuff. I want to have a gym nearby. I want to have a pool. I want this. I want that. I want a car. I want to be able to travel well. Okay. I want to have an annual vacation. We all want to live well. These things begin to play out. You know, it gets around the corners. 15 years, that's long term. And sad to say, but whether it's 1 year or 40 years, you always run into emergency money needs. So that's another money goal for which a money outcome or a money plan which you must have. You may have a medical emergency. You may go through a job loss. You can get sacked. I know a lot of people have lost their jobs in the COVID era. And of course, your family or your friends might face a similar emergency. There might be a calamity. There could be a pandemic, and we need the money. Yeah. So Kunal, the interesting thing here is that, you know, the middle two things, medium term and long term, we mark them in red, and there's a specific reason. Tax hacking is all about, you know, cracking and hacking into the medium term and long term money goals, and which look very unglamorous and which look very fuzzy and, you know, in the distance. But what has your own experience been in this? Has tax planning helped you save for your medium and long term, or is it just something you do in March?
I agree with you, and I think so. It's also one of the most ignored aspects, the medium term and the long term thing that we are seeing over here. The beauty about planning is that they are able to also incorporate a lot of things which you would have otherwise thought that you will never be able to look into. If you say, for example, when you put it down in a very, very simple one slide over here, a lot of people will be going through that. Yes, I need to look at this as well. I need to also look at my second child, or for that matter, my extended family support for that matter as well, which they would have otherwise ignored. However, they always wanted to do that. So those kind of things, any all with tax and say tax saving is like an incentive that yes, this is something that will take us. But definitely, yes, planning is something that goes and takes us a very long way. And that's where we need to go hacking and cracking.
Absolutely. We need to hack into our tax outgoes. It doesn't mean we look at tax evasion or avoidance. We need to do tax planning. A tax hack plans his or her taxes very, very wisely and solidly. Okay, next slide. Ouch. So there we go. So who is a tax hack? Am I a tax hack or not? Is Kunal a tax hack or not? And do you guys want to be, guys and girls, do you want to be tax hacks? So essentially, if you want to save on tax outgo and you want to create wealth in the medium to long term, remember, if you come back to the last slide, you will remember that the medium to long term, those parts were marked in red. And especially long term, because the power of compounding small sums of money over a long time is incredible. You will be surprised. Okay, we've all heard the story about, you know, 1 grain of rice on the first square of the chessboard, and 2 grains on the second square, and 4 on the third, and 8, and you keep doubling, and you see what happens when the compounding effect begins to play out. And after a few squares, you don't have so many grains of food in the whole world. Okay, so that's what compounding does. So long-term compounding with small tax savings every year, that's the power. Anybody who's owned a gulak in your childhood, anybody who's owned a piggy bank will realize, and remember, a piggy bank doesn't compound, it just saves. It's arithmetical savings, but compounding is geometrical savings. Okay, now to do this tax saving, what are
I add to you a very small thing over here is that even a small addition in your rates at which you multiply your money makes a very huge difference in the long term.
Right.
That's where the power of compounding really makes a lot of difference. So very well, compounding is something that nobody should ignore, and that's where what you are telling hacks create how to do it from this perspective will be a long way, will actually make a lot of difference.
Correct. So there are 7. So obviously there are like, 15, 20 ways to make incremental tax savings on a variety of things. Even when you pay house rent, you will save some tax. You pay for a medical emergency, you can pay some tax. You can save some taxes there. Or if one is disabled, sad to say, then one gets a tax break. And there are like 20, 30, 40 ways to save small installments or small pieces of tax. But the super 7, the 7 biggest ways to save taxes in amount, in size, in quantum. These are the 7 most important things that you should never lose sight of. And if you will notice, the item number 7, in my view, in my humble opinion, is the national pension system is probably the most, we'll come to that in a bit, but it's probably the most important and most underrated, underappreciated product here. So anyway, the 7 products that we want to talk to you about, the super 7 tax savers. And these products, the money that you spend on these products or invest into these products goes into various asset classes, which is the column on the right. So they can go into equity, which is the stock market. They can go into bank deposits, government debt, corporate debt, and of course, insurance companies put it into a protection corpus. Okay, so the 7 products are equity linked savings scheme. We've heard of this. Every year in March, the mutual fund guys start chasing us and say that, why don't you buy an ELSS scheme? Why don't you buy? So it's there, it's out there. It's a big way to save money, reasonably large way, not very big. So, and of course, there are tax savings, fixed deposits in banks. Whether it's HDFC Bank or State Bank or whatever, you can get a tax saving FD done in a bank. Now, these are all tax savers. So these are tax saving instruments, the first 2. If you look at health insurance, it leads to indirect savings. You forfeit the money, of course, when you pay a health insurance premium, but there is indirect savings via protection. Because in case you pay 20,000 rupees health insurance premium and you incur a 4 lakh rupee bill in a hospital, you've saved that 4 lakhs because the insurance company bails you out. Okay, so there is indirect savings in health insurance via the protection. That's the nature of insurance, right? You pay a small sum and protect yourself from a big calamity. Similarly, life insurance, which of course is now coming in savings and protection flavors, combined flavors as well. You can of course do a pure term, which is a protection only flavor in life insurance as well. And then there is employee provident fund, which of course all of us salaried people crib when our employers deduct money every month from our salaries, but it's a very useful way to invest, a very powerful way to invest. There is public provident fund, which you can voluntarily go and open in, let's say, a State Bank of India or any nationalized bank, and that's also a very, very powerful way to save every year. And of course, the NPS, the National Pension System, which we will examine in detail. So Kunal, as a CFO, of course, you are aware of far more ways to save taxes, but I think this should be the big 7, right? Are you in agreement there?
True. In fact, one of my favorites is obviously equity linked savings schemes, that is ELSS. I believe while you said the 7th one is the most underrated one, I strongly believe the first one is the most banned one kind of a thing. People see it way more riskier, but I think so they should look at it way more objectively, and definitely that is what you should talk about.
In fact, there's a beautiful little insight on the ELSS that I will bring out in the coming slide, and that should address that's actually in line with what you're saying. So the thing is that an ELSS is not just any equity mutual fund. Okay. Look at that 4th bullet point there. It carries the reward and risk of equity. Okay, so we know that equity, what was that line? Equity investments are subject to market risks, right? Read all offer documents carefully before investing, right? So of course it carries the risk of the stock market, and it has the shortest lock-in period of 3 years among tax saver instruments. But here's the beauty. It doesn't let you touch the money for 3 years. And most people get rattled when you go through a 10 or 20% drawdown in the markets. It forces you not to touch the money for 3 years. That 2nd bullet point is very important. Among the tax saver instruments, this is actually the shortest. But among mutual funds, apart from ELSS, there is no mutual fund which puts a restriction on your pulling out the money before 3 years, right? You may have an exit load or something, a minor exit load of 1% or something, but nobody stops you from pulling out money from there. The beauty of an ELSS is that it doesn't let you touch the money for 3 years, and at least 80% will go into equity. Okay, and the tax exemption that you get here, the tax savings that you get here, is that there's a section called ATC, which I think most people are familiar with. There is an umbrella amount of 1.5 lakhs per annum. Let's say you are at 30% tax rate. So you can save 50,000 rupees through all the instruments combined. There's an umbrella of 1.5 lakhs. So this goes into under that umbrella of section ATC, right? So yes, Kunal, I agree with you on ELSS. This is actually a lovely mutual fund product, and most ELSS schemes are schemes that have led on to create very good outcomes for their investors, simply because they stop the investor from withdrawing the money. Okay.
One more reason, Dipen, why I really like this scheme is that this scheme essentially makes people taste equities. Because a lot of people, if you see, they would have kind of thought that I should never invest into equity or never take that exposure, even if they are very wealthy or kind of they are just going to a very conservative kind of things. But this makes them introduced to it, and then they are able to experience the continuous growth that is happening in a country like India, wherein the GDP is constantly appreciating and the equity is appreciating. And then obviously we have one very important thing over here in ELSS, that returns that you earn, the appreciation that you do is exempt for up to rupees 1 lakh every year. So that is something which is kind of a most ignored part that a lot of people miss it, but that's very important to understand. And that's where it makes it a kind of a way more lucrative product, that even the returns that you earn, the appreciation or the LTCG is also exempt for 1 year. Obviously, over and above that, you are able to get a tax of about say 10% or so only, as against other instruments which may go at a higher rate.
Right, right. Excellent point. So that's something I actually haven't mentioned there. That's worth mentioning. We'll update the presentation. Thanks. Great. So then, of course, the simple product here, the second one on our list, is the tax saving FDs or fixed deposits in the banks. So FDs are normally, I mean, it's obvious that they belong to the debt asset class. It's very, very safe because unlike equities, the returns are just in a straight line. And the interest rate is guaranteed contractually by the bank, and it is fixed for the term. So you also don't suffer any interest rate risk. And the lock-in is 5 years. Among the debt instruments, this is the shortest lock-in. Among the equity instruments, it is the ELSS, which gives you the shortest lock-in of 3 years, but this one is locked in again for 5 years. Again, this also qualifies for the ATC tax benefit umbrella. And of course, you can choose monthly or quarterly interest payout. But however, keep in mind that this interest payout is taxable. Okay. And also that since it is taxable, TDS will apply unless you submit a Form 15G. I doubt if many of us who are attending this are in a position to be able to submit this form, because we would all be in the taxable bracket, so there's no way we can submit it. Of course, some of our parents who are senior citizens now may be able to apply on Form 15H. So this is a simple product. I don't think there is much to discuss here, which brings us to the third product. Kunal, you want to take this? This is a very interesting thing here. It's not really a savings product. It's a tax hacking product, if I can call it that, but it's an indirect savings product, Kunal.
So that's correct. In fact, this is something which is very, very evident. And in fact, these are the times in pandemic where we see the most need of this particular product, wherein we are able to see that this tries to actually cover you, not only give you a tax hacking and a tax benefit. This incentive makes you really saved from all kinds of medical hassles, and medicals nowadays is very, very expensive. The second point is one of the very interesting points that we have in this is start when you are young. The interesting part is that you start with a lower premium and continue to remain at a lower premium for a long period of time. And that's why starting with the young also makes you the chances of claims rejection very less. When you look at the deductions, 25,000 for yourself and your spouse, and there is
there's an additional 50,000 for
to
senior
also
citizens.
cover our family.
Right.
Yeah,
right. Yeah, so it's an indirect savings product actually, Kunal, because you don't really get the money back, but you get much more than your money back in case there is if there is a health event in your life, right? So it's a beautiful
thing.
Yes.
A lot of companies have actually started giving an insurance in the way in which it also covers COVID expenses and COVID home expenses as well. So if you are
Right.
getting a COVID home and that thing, so that is something which really excites people that, okay, fine, even if I'm quarantined and I'm at home, already getting really bogged down mentally as well, getting down. But this is something, it's an incentive. And I'll tell a small story of my friend in Singapore. He got COVID and he didn't get COVID, but he was quarantined as per the regulations because his cab driver actually had COVID. But he had to get quarantined for 14 days, and he was incentivized by Singapore government every day as $100 Singapore dollars. And he was so happy about that fact. So that is something which this product also brings in, and that reminds me for that aspect as well. So
Yeah.
obviously, this is something people should more look at it now.
Right. Right. Okay, so which brings us to life insurance, another insurance product, and there is something known as a unit-linked life insurance product or plan. So the broader take on life insurance is that it's a must for every family that has at least one earning member. That brings in the insurable interest, so to say, in the language of insurance. Anybody who is a regular income earner needs to be protected. A pure term plan or a protection plan is when you only pay for the life risk. Just like health insurance, you pay for loss of life to cover the loss of life. So maybe you pay 1,000 rupees every month and your life is covered for 1 lakh rupees every year. Sorry, so you pay 1,000 rupees a year and maybe your life is covered for 1 lakh rupees or some such amount. You know, the actual arithmetic, of course, depends on your age and which vendor you're buying it from and so on. There is a second variety of life insurance called an endowment plan or product, which combines protection, pure protection and savings. So you get some guaranteed returns after the end of the premium payment period or even intermittently. Okay, and of course you get the protection, and it could be during the premium payment period or even for the rest of your life and so on. So there are many combinations there. So you can buy a term plan, you can buy an endowment plan, you can even buy a ULIP, wherein the savings don't give you guaranteed returns, but they give you market linked returns. So these are different flavors of life insurance. Like health insurance, life insurance is advisable and cheaper to start when you are young. You need to start early. Deduction for life insurance actually comes under the 80C umbrella, not 80D, which is available for medical insurance, which is over and above the 1.5 lakhs. But this 1.5 lakhs umbrella also includes all insurance premiums that you might pay for LI or for ULIPS, right? So this is another very, very essential tax hacking product that most people do avail of, and I think it's highly recommended for all of us. And there is nothing to argue much about this, the virtues of life insurance. Which brings me to the next product, which is the two unglamorous provident funds, as I call them, the public provident fund and the employees provident fund. So what we call PF, or actually EPF, the second one, and PPF, which is something that you can set up on your own. Even if you're not employed by anyone, you can set up a PPF account at a PSU bank. It gives you long-term savings and guaranteed returns again. And voluntary contributions can be made, you know, by an individual, independent of your employer or your business or whatever. And the interest rate right now is 7.1%. When I started a PPF, I used to get as high as 9%. Okay, or was it 8.5%? So it's fallen, of course, like in line with all other interest rates. This is fixed by the government of India from time to time. The beauty of this product is not only that you get the 80C umbrella benefit included here, that all your 80C combinations you can work out depending on your preference, so long as you avail of that 1.5 lakhs. But even the interest that you earn is tax-free completely. I know so many people who have accumulated more than 50 lakh rupees over a period of time in their PPFs. This is a 15-year product, by the way. That's something I forgot to add here. So you keep saving for 15 years, and people have accumulated 30, 40, 50 lakhs in this. I know so many people who've done that, and they realize now, oh my God, how much money I've saved after all these years, you know. Okay, Kunal, EPF, this is something that bites into my salary check every month. And as CFO, I think you have to face some flack from employees that why are they losing out on EPF? Why are you deducting money? Maybe you want to defend a little bit here.
That's a regular thing, that my take home is lesser than what is my CTC, and that's a fight
Yes.
I keep on banging people regularly. But they do appreciate after a few years that this is something which is actually giving. In fact, if you see the interesting part, among the debt products, this is one of the highest rate of interest, and also having it tax free also later. So that is something that helps us to try and maximize the kind of things. It has a benefit over PPF as well. So that is something which lures people as well. So, but I agree, yes, it's biting on a day-to-day basis, month on month. When you
Yes,
see your paycheck is
so
lesser than what it should.
yes, Kunal, people argue, about this, and they don't realize that eventually it's a wealth nest that is getting built in the background. In fact, these
Yes.
deductions prevent you from spending things on stuff that you actually shouldn't spend on. We talk of the consumption story in India, but traditionally we've been a high savings economy. Of course, savings rates have now
And even
fallen
now
by.
for that matter.
Yes, yes. So, I come from a family where conjuice is actually a word that is meant to be, a word of praise. I don't know how your family was, but if someone used to call my dad a conjuice, my dad would feel very happy.
No, that's correct. In fact, lot of places that is what it is. But I'll tell you, if you see the PPF, the characteristics is such that while there is a lock-in of 15 years, you can actually go up to 30 years. And when you can go up to 30 years, going on extending it by five years, people start seeing it as a complete backup for everything over a period of time, and it goes on from generations to generations. So
I
that
know
is
PPF is
something
a
it
fantastic
become
product.
a very popular from that perspective as well.
Yes, I actually know of a businessman who went bankrupt, and he told me that the PPF is the only corpus that an Indian citizen can have, which cannot be touched even in bankruptcy recovery filings. You know, nobody can touch that money. I can take out your wealth, your gold, your real estate. I can liquidate all your wealth, but I can't touch by law your PPF money, your public provident fund money, even when you owe it to me. If you've gone
That is
bankrupt, that's
correct.
the last thing. Sorry?
In fact, I found that's very true that nobody can recover it. And in fact, that motivated a lot of people to start creating family trusts and kind of try and make it a similar thing to this. And that became a very popular product as well because a lot of people were
Yes.
actually able to try and see what we can do and how we can save something which is untouchable.
Yeah, I know, exactly. So there are these 5 or 6, if I can quickly run through the tax hacking products that we've gone through. So here we are. The ELSS we've spoken about, the virtues of having equity logged in for 3 years, a tax saving FD in a bank, of course, with 5-year, money getting out of your hands. It's a good idea to have health insurance, which is actually indirect savings via protection, life insurance and ULIPS. So you get a little bit of savings, a little bit of protection. All these are ways and means to hack taxes and create wealth in the long run. And of course, EPF, PPF, the unpopular twins, but who are of course very virtuous. Which now brings me to the NPS, which if you will allow my saying this, Kunal, this is the least known, and this is in terms of size, in terms of quantum. It's funny, but it's the biggest instrument for tax hacks. It's a tragedy that people don't know about NPS, don't know enough about NPS, and that's one of the reasons why we are holding this webinar. Not only to get you aware of all the possible products, the top products, but the biggest possible products with the biggest possible impact. And the impact that NPS can have on your savings life, as it were, is incredible. And we'll come to that in a minute. Okay, so the first thing in NPS is that it's a long-term, it's an ultra long-term, if I can say so, accumulation and compounding product, because it goes on till you are 60 years of age. So imagine if you are like 25 years old today, you can actually do a 35-year compounding and accumulation if you start on NPS. Now, who wants to plan for 35 years? Well, you'll be surprised at how much money you can build in NPS over 35 years. Okay. It's crazy the kind of compounding. Remember that story about the chessboard and the grains of rice? So by the time you reach the 35th square on the chessboard, you will have some crazy amounts of grain. Okay. The second point here is that there are huge and exclusive tax benefits. We'll come to that in the next slide. But this is not about some benefit which comes in an umbrella under that 1.5 lakh limit, under ATC or something. It's there. It's part of there as well. Part of ATC, it figures in the umbrella, but it goes way beyond the umbrella and at a size and scale which is unbelievable. We'll come to that. Okay. The third point is actually a very funny and insightful point. Again, people can't believe this. The fund management fee for your NPS money. People like SBI, HDFC, Kotak, ICICI, all these asset managers manage mutual funds, and they also manage, let's say, equity funds or debt funds for the NPS. Okay, and you can choose any one of them. You don't like X, you can go with Y. You don't like Y, you can go with Z. And let me tell you, the differences are actually negligible in what they are posting in terms of the returns. But the funny thing is that they just charge 1 BIP, 0.01%, even for equity. Just imagine when they run equity mutual funds. I hope there aren't too many mutual fund people out there in the audience. But when you guys manage equity mutual funds, you're charging 200, 220 bips, 250 bips. 2.5% every year to manage equity. And here, when I give you equity to manage under NPS, you're just charging me 1 BIP, 0.01%. And you know what? In about 35 years or so, which is exactly the number, you're at 25, you go up to 60 in this product. In 35 years, that 2% savings actually gives me double the money at the end. In 35 years. I've done this on a spreadsheet for those of you who don't believe this. I've done it this morning. I couldn't believe it. 1.99% is actually what you save every year managing an equity mutual fund. Whatever be the return, you will get double the return compared to a 2% load in another mutual fund, a management fee load. Okay, this is an incredible point which people don't understand. 35 years of compounding at 2% or 1.99% doubles your money in terms of final outcome. So if you're saving 1 lakh every year, and after 35 years, if that was going to become like 1 crore or something, this will become 2 crores. It's crazy. Okay. And of course, even the maturity outcome is tax efficient, which is what Kunal referred to in the ELSS bit, that up to 1 lakh of money earned, of income earned every year from ELSS is tax free. Well, you know what? When you withdraw 60% of your corpus at the end of your 60 years of age, whatever you've accumulated, let's say you accumulated 1 crore, including all the accruals, savings, returns, everything. Well, 60% of that you can withdraw tax free. You don't pay taxes. You actually save taxes when you put it in, and you don't pay taxes when you pull it out. Wow. Wow. Exempt, exempt, exempt. Triple E product. Okay. And even partial withdrawals on the voluntary bit. So there is a compulsory bit or a statutory bit which you save taxes on, but when you can also have a second tier account in the NPS. We'll come to that. And when you withdraw even 25% of that anytime, even up to the age of 60 years, partial withdrawals of up to 25% of your voluntary contribution, they are also exempt from tax. So it's not that there is a lack of loss of liquidity. The voluntary part, there is actually just you get 25% liquidity of your voluntary contributions also anytime during your life. Okay. And of course, you can choose a flexible asset mix. You don't like equity, you want to put it all into debt. You can go up to 75% into equity here. You must keep at least 25 in debt. That's the condition in NPS. And frankly, this is the funny bit. I don't know how many of you know this, but debt has been a better asset class over the last 3 years, last 5 years also in equity in the markets. Very few people know this. Okay. By the way, 5-year returns are pretty decent in the NPS schemes. So their equity funds have returned something like 7.5%, 7.8% versus 7% for Nifty. The corporate bond fund and the government bond funds have returned in excess of 9.5%. There you go. Kunal, this sounds like a no-brainer, buddy.
That's correct. And in fact, you see the section that is there in income tax which provides it, while you can always claim this in ATC, there is also a section of ATCCE. So you can actually claim a lot additionally as well. And that is what people actually miss out on. And in fact, if you try to see over and above these things, there is something which people completely ignore. That is, if you go for more than 60 years, is what people locks their brain and say, oh, it's completely wiping out my liquidity. But the 25% that is allowed to be voluntarily withdrawn is something people keep on missing every time. So true. It's a complete no-brainer.
Yeah, so Kunal, this is where your CFO instincts are going to be very valued in this conversation. See, I can see, so can you see this next slide that I've pulled out? And this is where you really need to, bring out all that wisdom of yours in helping our audience figure out. So there are 2 star items here, and these are exclusive and crazy items, that are available in NPS, which are not known very widely. So the first one is that, um, you can go beyond the 1.5 lakhs contribution, that umbrella, right?
Correct.
And you can put in another 50,000. That's what the right hand column tells me. So let's say across your life insurance products or your PPF or EPF, you already exhausted that 1.5 lakhs. So even those products, when they go up, and when all of them, when they add up to more than 1.5 lakhs, the incremental benefit from them really doesn't come through to you. But you can put in 50,000 more into NPS now. And if you put 50,000 into NPS, your deduction from taxable income goes up to 2 lakhs as a result of this, right?
Correct.
So that's the first one. It's something which is exclusive, which is why we put a red star out there. And the second one is a whopper, boss. We are not talking in thousands now. We are talking up to 7.5 lakhs. Now, this is crazy. I haven't heard of a tax product which gets you to save stupidly like this. I mean, so we know that you can go from 1.5 to 2 lakhs tax deductibility. We know that you can go to, get that other 50,000 only through NPS. But now we are talking 7.5 lakhs. What the hell is this?
That is something, I believe, okay, it is always that if you are ready to take a lesser take home, your employer will easily allow you, and you can go to a significantly higher amount as well in NPS. The thing is, if people are able to appreciate that they will not really get bogged down by the 60-year thing, then this turns out to be a super no-brainer kind of a thing,
right,
as always.
Yeah, so I mean, and the sheer quantum is so large. After
Yes.
that 2 lakhs, theoretically you can contribute another 5.5 lakhs per annum. Of course, the cap is that to avail of that entire 7.5 lakhs deductibility from your total income, your total EPF, the employer contribution to employee provident fund, plus your NPS contribution, plus your superannuation. So let's do some mock arithmetic here. Okay, let us say that I have EPF alone from your salary slips that you make for me every month, I have exhausted 1.5 lakhs. So I put another 50,000 in NPS, right? And then I take that deduction to 2 lakhs. But there is also a superannuation contribution of 50,000 every year that HDFC Securities might do for me. So that's 2.5 lakhs. So you mean to say I can put another 5 lakhs into NPS and get that as deductible from my total taxable income?
That's correct. There are certain caps that we have over there, but it's crazy.
Overall
In terms of, if you say 10% of your salary and other kind of things, there are limitations. But yes, if you can go as far as if that is higher, and that is where one would want to contribute, because they will have a more surplus disposable income. But that is something which will help one to kind of go ahead and do the deduction. The taxability section allows it, so that's the beauty of it.
So Kunal, this middle point is crazy. I mean, if I'm saving like 5 lakhs more, I mean, if I'm getting a deduction of 5 lakhs more, that's something like 1,75,000 saved in taxes over the year, just by putting this 5 lakhs away at one go.
And that's to exempt.
Yeah, I mean, I think this is crazy. This is and there is no such tax hacking instrument of this size, of this magnitude, right?
True.
For a salaried employee, I don't think there is anything. This middle row, guys and girls, this is important now. Okay, we are talking big stuff here. There is and imagine if I save this 1.7 lakhs every year for the next 10-20 years, and of course I do that compounding into whether equity or debt or whatever kind of thing I choose in the NPS fund, and the fact that it is managed at such low cost of just 1 bp. Okay, so look at that compounding potential over the long term. Look at how time begins to serve me. You know, as I grow old and I say, oh, but time is killing me and time is taking its toll, I'm actually building a huge tank of savings out there. And like I said, long-term compounding is crazy. You know what it does after the first 5 or 10 years is something which is, I think, people in their 20s and 30s may not appreciate right now. Of course,
And that too, you will be able to switch between equity and debt. In fact,
oh,
you can go up to as high as 75% into equity. So that is also something very crazy.
yeah, this is something very interesting because it's not that my decision is cast in stone, Kunal. So today I feel, array, boss, markets are back to almost 11,900, 12,000. I don't want to put money into equity. I'll wait for them to come to 10,000. And I want to go like 100% in debt. I can do that. Let's say markets fall to 9,000 after this. And I say, oh, I think Nifty is at a good price now, and I need to switch to 75% equities. I can do that right away, right? In the NPS. I just have to, and
That's what
yeah,
you can time it.
I think I can time it. I mean, who can time the markets? But yes, if you want to do that. So all this flexibility is there. And with such a huge tax saving when you allocate money with just 0.01% or 1 bp of asset management fees. And of course, as you can see in that last line in the box, that voluntary contribution within the ATC umbrella, of course, up to 10% of salary and availing of a benefit of up to 1.5 lakhs in that umbrella, that of course is there like any other ATC product. Whether it is life insurance, whether it is PPF, whether it is EPF, all those things are adding up to 1.5 lakhs. If they are not, of course, my NPS contribution will also count in that 1.5 lakhs umbrella. But you know, that's the least of the reasons I would go to NPS for. I don't know about you, Kunal.
People would actually want to use ATC for all other things rather than really using it for NPS.
Yeah. So I would use the other products for ATC. I would take full advantage of this 50,000 which is there on the first row for ATC, ATCCD 1B, or call it whatever you will. Yes, that's the section. There it is in the box, in the middle box. So I can get another 50,000 deduction on my taxable income from there. And guess what? Even after 2 lakhs, I've got headroom for up to 5.5 lakhs, but I'll have to see what my EPF, NPS and superannuation contribution from my employer is. And let's say if it is like 2 lakhs or 3 lakhs, then I can go up to another 4.5 lakhs. Wow, this is fabulous. Yeah, the two starred items are crazy and they're completely exclusive to NPS, right?
True. Eye opener for everyone.
Yeah, I mean, I'm surprised. I'm completely surprised. I'm sorry. I think I've been able to unshare my screen. I don't know whether you guys are. Can you see my screen now?
No, we can't see your screen any longer.
Okay, let me try this again. Sorry for that accident.
When you got very excited with NPS.
Yeah, I think I pressed the wrong button here, but I'm not sure. Can you see it now?
No.
Not yet.
Okay, so hell. Okay, so we're close to the end of the presentation, but I'll give it one last shot. Just give me a minute, sir.
We can see it now.
You can see it now?
Just make it full size.
Thank you. Yeah, I just have to make it full size. I'm so sorry for this. Okay, good. So I can't emphasize this anymore. I got so excited, I went and pressed some wrong button. It looks like while I was shaking my hands around. Sorry. Unqualified apologies to the audience. But I think this is a fabulous product. And if we just run through all the 7 tax hacking products, of course there are like 20-30 ways you can save taxes, but they all give you complicated in small ways. These are the 7 big ones. Okay, the ELSS, I hope you can see the list of 7 now.
Yes.
Thank you. Sorry again. Okay, so you save tax and you create wealth in the medium to long term. I'm proud to be a tax hack, okay, and I want each one of you to become a tax hack. There's a whole lot of glamorous stuff to be done with HDFC Securities in the stock market. You can buy mutual funds, you can invest directly into equities, you can buy baskets, you can do stock SIPs, you can buy life insurance, health insurance, all of that. But the first thing you need to be is a conjuice, and you need to save taxes. Okay, And that's a very serious comment. And when you save taxes every year over the medium to long term, you'll multiply your wealth. Here are the 7 big products that we've got to recommend to you for saving taxes. National pension scheme system, of course, seems to be the best one and the biggest one in terms of impact, but the other 6, don't underestimate them. Okay, now which brings us to the end of this discussion, and I'd like to open it up for Q&A. I hope the audience will allow me a little bit of a plug or a pitch for my firm. Why should you do business with us? So, well, we give you all asset classes and investment products: equity, debt, mutual funds, commodities, currencies, insurance, global investing, even NPS, under one roof. We give you 360-degree investment advice, savings, and financial planning solutions. We give you news and views backed by extensive research, and of course, instantaneous and seamless account opening at hdfcsec.com. Whether you use the DMAT plus investing product, you want to open an NPS account, you can do that with the Government of India through us, and we'll be more than happy to take questions from you now. Okay, Pratibha, open it up for questions, and let's see what our audience wants to ask us today.
So a lot of questions, very excited audience. We have a query from Mr. Saurabh Shah. How to compare or choose right channel to invest between equity and through mutual funds? Within mutual funds, how to choose the right fund type, sector, etc. What should be the minimum expectation of return in the current market scenario?
So answering that question will take the rest of the time. But so Mr. Shah, the first thing I would say is that you need to be, so again, a little bit of pitch for the firm. So you need to be our customer, and if you were indeed our customer, then you would have got answers to many of these by now. And if you are our customer and still don't have answers, well, let me say something is wrong with your relationship manager. But more seriously, I think between equity and mutual fund, direct equity and mutual fund, the simple answer is that if you want to invest not just your money but your time, even if not on a daily basis, but from time to time, if you want to be in charge of your money and don't want to entrust it to another person to manage the money, if you think you can do that, I think you should invest directly in equities. Most people do a bit of both so that they can understand how are the best fund managers in the country managing my money, and how have I done it over a period of time? What are the outcomes like? So that's the sensible answer. The second thing is, within mutual funds or equities, how to choose. Well, in equities, you have to do your own research. You have to read the research that we send you. You have to see the investment ideas and the trading ideas that we share with you from time to time. A lot of people think that, and I completely respect them, although I believe in long-term investing, but a lot of people do believe that trading continuously on the markets is a great way to make money. I think there are some merits there as well. You could trade in the derivatives market, you could trade in the cash market, you could do margin trading. We have all these options for you at HDFC Securities, Mr. Shah, and you'll be surprised at the kind of excitement that you can get, not to mention the natural risks and rewards of investing directly into equities that you will get when you sign up with us. In mutual funds, you need to have a slightly longer term horizon, not a month or a quarter or a day or 6 months or a year. You need to stay invested in mutual funds, carefully select them based on your appetite, your risk reward appetite, whether you want to invest in small cap funds, large cap funds, multi cap funds, mid cap funds, or a dynamic asset allocation fund, debt funds. So there's a whole lot of range of investment avenues to choose. I think spreading your risks across various asset classes, mutual fund classes also makes sense. Don't over diversify, for sure. And of course, if you want to self-drive, then get into equities directly on your own. Next question.
We have
also
a query from
on the expected return that you are asking a question. I would just like to add a small comment that over a period of time, especially if we see last 3 to 5 years, and more importantly, last 3 years, we have seen a drastic fall in the overall interest rates, maybe more than 300 basis points, that is 3% per annum. So you should, while you look at historical returns, you should also moderate your expectations in returns, because it will not necessarily something that you may have earned historically, and that's what interest rate cycle has been.
True. I think so. In fact, appreciation of the interest rate cycle is something that is sadly lacking in many investors. A long bond fund gives great returns in a falling interest rate regime. These are some natural lessons that I would expect students of finance to know. So chartered accountants like you, Kunal, will know that, but even engineers like me have painfully learned it over a period of time. Yeah. All right, Pratibha, next question.
So we have a query from Mr. Panda. He says most of the Super 7 products fall under 80C of tax savings scheme and has a cap on the maximum amount, which is 1.5 lakhs.
It's
Also,
part
the
of the umbrella.
interest rates are ever decreasing in current scenario. So how will people gain sufficiently from these instruments, or how to smartly manage these investments under these?
So I think what Mr. Panda is worrying about is the fact that the returns profile in many of the fixed income or debt savings instruments is gradually coming down. Like I said, when I started my PPF account, it used to earn maybe 8.5 or 9%, and now it's down to 7 point something, right? So paisa to dal rahe hain, it's making money, but it's not making money like it used to, and it can go down even more. So I agree with the broader principle that how it hurts you when these instruments make lesser money, but you make upfront savings in taxes when you invest here, and these instruments still give you the best fixed income returns that there are in this country, right? So EPF, I don't remember how much is the EPF return right now, Pratibha, on the Employee Provident Fund.
Around 7.1%.
Okay, no, I think EPF is higher than PPF, but I'm not sure.
No,
Anyway,
EPF is 8.5. It's PPF,
yeah,
which is 7.1.
yeah, it's the Public Provident Fund, which is 7.1. So even 7.1 and with tax-free returns corresponds to well over 10% pre-tax returns. Now, who the hell is giving you 10% pre-tax returns? I mean, bank deposits are down to 5 and 6% now. You're making double the money, Mr. Panda. Now, how much more do you want? If everything is relative. So compared to 5 years ago, maybe you're making lesser money on these instruments, but compared to what is available in the market, you're still making stellar returns. Plus, add back the impact of savings of taxes when you put money here. And of course, the ELSS schemes, which are not fixed return schemes, which go with the return profile and the risks associated with equity. I think when you don't touch your money for 3 years in the stock markets, the chances of making a decent return go up substantially. Everything is subject to market risk, fine. But why just 3? Leave a mutual fund alone for 4, 5, 10 years and watch the fun. Yeah, next
So
question.
in fact,
Sorry.
then at times, I strongly believe Mr. Panda should also explore ELSS strongly, because he may have not necessarily experienced it, and that also has a higher return. Probably have a direct answer to his question.
Yeah, but to be fair, I can't assure you a return on ELSS.
Obviously,
Market risk takes over. So I don't want to provide any leading thoughts here. We know the general principle is that equities deliver excellent returns ahead of debt over longer periods. But then sometimes there are tough periods as well, and let's not forget that. So we need to allocate across these various instruments, and that allocation is still subject to the overall cap of 1.5. Remember, you get another 50,000 when you stack up on NPS, and then you get potentially another 5.5 lakhs even beyond that 2 lakhs, and that the 20-30,000 coming from every source becomes so insignificant when you see that you have a 5 lakh headroom in NPS. What about that? And if I'm at 30% tax rate, and if I put 3 lakhs there into that over and above 2 lakhs portion in NPS, I'm saving 1 lakh at one go. What are we talking about? Across all my instruments under the 1.5 lakh umbrella, let's say I've saved 45,000 at 30% in tax rate. But in the 3 lakhs at one go, I'm saving 1 lakh. Wow. So NPS is it's like the engine, and the others just look like the little compartments at the back. If NPS is not your engine of tax hacking, I don't see how your train is going to move forward, boss. Yeah, next question.
Yeah, all right. So, Mr. Panda, I hope that your query is resolved. So we have a similar question from Mr. Rajat Mathur. Majority of 7 tax saving instruments help save taxes under 80C. If I already have exhausted the 1.5 limit for this section. Which options should I look at?
तो माथुर साहब, we've been talking about this. कब से हम लोग यही बातें कर रहे हैं. And now I think when you asked this question, maybe it wasn't so clear, but I think आपको जवाब मिल चुका है इस वेबिनार में. तो 1.5 लाख के ऊपर और 50,000 NPS में बचता है, and उसके बाद भी 5.5 लाख रुपए का हेडरूम है, डिपेंडिंग ऑन योर ओन सैलरी अरिथमेटिक, सुपर एन्युएशन, PF कंट्रीब्यूशन वगैरह लेकर उस 5-5.5 lakh में से maybe you will have 2-3-4 lakhs left over to avail of, and such a big boost to your tax saving. I know all of us are frustrated. Why only 1.5 lakhs ka umbrella? One of the representations we should be making to the government is that they should increase that ATC umbrella to maybe 2 lakhs or 3 lakhs or something. But I don't think it's going to go to 7.5 lakhs in a hurry. It just brings back this argument of how fantastic NPS is and what a big ship it can be. What a big instrument it can be in that entire bunch of savings options, tax saving options. Right? I mean, what is 1.5 lakh? What's 50,000? I mean, you've got another 5 lakh headroom there. What are we arguing about? There are 10 instruments here which add up to 1.5 lakhs under the umbrella, and I've got one little instrument which is giving you 5 lakhs headroom. Wow. And people don't know about this. Everybody talks about ATC, and everybody's invested in employee provident fund. Everybody's invested in public provident fund. They put money into tax saver FDs. Some of the more adventurous people have bought ELSS because they say, okay, returns are also tax free. Hell, there's 5 lakhs left over for you. Do you know of this product called NPS? It's crazy. Yeah.
Yeah.
So I hope Mr. Mathur's question is answered, and trust me, Mathur Sahab, if you think we haven't given you a good answer, feel free to type out another question for us.
So we have a question on ULIPS from Mr. Manoj Gupta. He is asking, do you really recommend, given the very high cost? Also, we are not mixing insurance and investments, which ideally is not recommended. Instead, don't we suggest them a plan and investment separately?
Yeah. So, the arithmetic is a little involved. ULIPs do combine protection plus savings, and it might initially look like ULIPs come at a high cost. But after you've spent the first few years in a ULIP, frankly, the fund management costs taper off, and quite drastically, let me tell you. So we can share a spreadsheet on this one at some point of time, and we've done a lot of detailed analysis on why actually ULIPs are a wonderful idea. All other things remaining the same. The fund management quality has to be top class. If you assume like for like returns in ULIPs, they are actually, so you might be surprised at some of the insights you can draw as to why ULIPs make sense versus buying, let's say, mutual funds separately and term insurance separately. But those benefits tend to accrue after a few years. They tend to kick in after a few years. So if your persistency is going to be high, you're not going to walk out of an insurance plan. Taking a ULIP very early in life is a lovely idea, I can tell you that. Okay, next question.
We have a query from Sutapa Nandi. They ask, I already have a company medical insurance of 6.
Right.
I will retire in 13 years.
Okay.
The question is, I already have a company medical insurance of 6 lakhs coverage. I will retire in 13 years, 13. If I have to start a personal medical insurance, I want to do it for a minimal premium. How much should that be? Also, post-retirement, can I increase my premium and coverage?
So I think medical insurance is a complicated decision to take. Don't worry about whether your employer has given you medical insurance. It's just going to drop off when you stop working. So always do your own medical insurance as well. And should you go through a medical emergency while you're employed, then first use your employer's medical cover to avail of whatever protection that you need at that point of time. And only after you run out of that protection is when you should use your own cover. But it's a good idea to pay for your own cover, because by the time you retire, Shutapati, you will be old, and sad to say, your insurance premiums will shoot through the roof, and you will be retired. You will not have a steady income, and you won't feel like paying those premiums then. Okay, so you should be availing of personal medical insurance, in fact a family floater or some such. So these are decisions where you need some consultation and counseling with your insurance advisor. We are happy to do it for you. In case you are not a client, you can always register and become a client of ours. You may not like stock markets, but you can still become our client and avail of insurance. You can buy mutual funds through us. You can subscribe to NPS through us, and while getting into the nuts and bolts of your specific argument, this may not be the best forum, but we are more than happy to help you and many others like you who may not be our customers, but can always sign up with us for these services. Like I said, we are giving you the full gamut of protection, investment, and tax saving products at HDFC Securities. So allow me the sales pitch here. Mrs. Nandi, you can come to HDFC Securities anytime and avail of this entire suite of products. We are a supermarket for this stuff.
We have ELSS related. It's not a tax related query, but ELSS investment. So they are saying that Mr. Sanjay Jain is asking, I'm already saving 1,50,000 under ATC via PPF and EPF.
Yeah.
Should I still consider ELSS as an investment option?
Excellent question. So जैन साहब का सवाल बहुत इंटरेस्टिंग है और इसका आंसर थोड़ा कॉम्प्लिकेटेड है, तो I will leave it to Sanghavi साहब.
Yes. So essentially, when you try to say you are putting into EPF, you are putting into PPF and EPF, you are exhausting your limit per se. And that is where you may not necessarily see an incentive of tax into ELSS, but you are missing one important ingredient over here, that when you take an equity exposure, your diversification which you need to do from debt and equity, that is missing, because EPF and PPF both are debt instruments, and when there is an appreciation in the long run, you have 1 lakh rupees which is tax free in case of ELSS. So you can diversify definitely by putting it in equity. There is no additional tax benefit upfront, but later on it is something where you definitely see some kind of a benefit in terms of ELSS that you are doing. Although EPF and PPF both are exempt. So there is no as such a per se tax comparison, but from a diversification perspective, you can definitely look at that. And once you start understanding that, you will experience that over a period of time, you are able to well have a bouquet or a portfolio which is having a good mix of equity as well as debt. I hope that kind of answers. And in case you feel that there is something more to discuss, I'll be more than happy to take it as well.
Yeah, so one message I would give to everyone who is on the webinar is that, I don't think we can exhaustively answer all your questions to your satisfaction, and we must apologize for that. This is a public forum, and a lot of the answers will involve specific arithmetic at your end. But do feel free to get in touch with your relationship manager at HDFC Securities. And as always, if you're not yet a customer, I mean, what are we doing here? Why don't you sign up? Right.
In fact, Dipen, I would like to put it this way, that the question which has been asked actually goes back to the fundamental thing that the umbrella of ATC of 1.5 lakhs tries to fit in a lot of beautiful products, which generally people may be investing into and maybe exhausting that limit. And that calls for a representation to be made to government that we should actually try and increase that limit for in all fairness for everybody.
Yeah, and while the government responds or doesn't respond in the interim, there is a 6 lakh rupee upside that is possible in terms of tax deductibility from 1.5 lakhs all the way up to 7.5 lakhs, that even without any government policy change, you can get that potentially up to 6 lakh rupees of additional tax deductibility, which is like 4x of what this ATC gives us. 6 more lakhs is possible to deduct from your total income and save taxes through NPS. If NPS was well known and well advertised, it would probably be 20 times bigger than it is today. That's the tragedy of this product. It's such a great product and lesser known, and it's completely a small tragedy that so many of us young people especially who have got 10, 20, 30, 40 years of savings life ahead of them can build huge corpuses for themselves by doing this. Okay, more questions, Pratibha, or are we running out of time?
We have many questions. I'll take a couple of them more.
Let's hurry up.
We have a very interesting question from audience, millennial question. My age is 27. Mr. Vyas is asking, my age is 27 right now, and I feel confused every time I hear about saving taxes with these methods. Please suggest what among the discussed 7 methods I should focus right now, and what others I should focus in the coming years. I'm putting 1.5 lakhs in EPF and FD and 50,000 in NPS each year right now.
There you go. So Mr. Vyas, you're 27. I hate to confess, but I'm close to double your age. And even I am confused on how to save taxes. So join the club, okay? Except for chartered accountants and accomplished financial wizards like Kunal, the rest of us will always struggle about the detailed arithmetic and the logic and the rules and the by rules and the 80 CCDs and 1s and 2s and all of that. But even I have figured this out, and by the end of this webinar, I'm sure you've also figured out that 1.5 lakh limit under ATC looks too small. 25,000 rupees of additional savings on health premium payments, maybe 50,000 more for senior citizens. Even that is just another potentially 75,000 of savings. House rent savings is calculated in a complicated 3-way structure, which I break my head over every year. And then there are so many chota savings that or tax savings that we can plan, but it all adds to a few thousand here and there. That 10,000 rupees of interest deduction from bank deposits and some such. These are such small things. There is a 6 lakh rupee monster staring you in the face, and that's called NPS. I'm not a chartered accountant. मेरे दिमाग में बत्ती जल गई है, कि boss, this is a huge way to save money. Look at the quantum, and look at what it can do for you. If I put away 6 lakhs into NPS, yes, you are contributing that 50,000 more. So you've taken your savings, your tax deductibility from 1.5 to 2 lakhs at one go. You've still got 5.5 lakhs to go. How much of that is available to you is a function of how much your employer is putting into superannuation and so on. So there is that little complicated formula that we alluded to, but I'm sure 2, 3 or 4 lakhs will be available for you. And you can always consult us on this. You can consult your chartered accountant on this. And of course, if you run out of chartered accountants, you can always call up Kunal.
So sir, we will take one last question here from Mr. Sunil Sahu. He says, so after ATC, 1,50,000 investment, we can still invest 5 lakhs in NPS, which is going to be tax free. Is my understanding correct?
So like we said, okay, so let's get back to that slide. And in fact, this is important to bring out. Yeah, I hope you can see the relevant slide now.
Yep. Yes.
Yes. And what was this this gentleman's name? Mr. Sabu. Is that right? Or what did you say?
Mr. Sunil Sahu.
Sahu. So Sahu Sahab, this is what it is. Look at that middle row. Okay. And so you can take if you look at the top row, you can take that 1.5 lakhs benefit up to 50,000 more. So you can, under section 80 CCD 1B, you can go up from 1.5 lakhs to 2 lakhs by taking an additional NPS contribution beyond 1.5 up to 50,000. Okay, so you can take that extra tax benefit. Then 80 CCD 2 is the big whopper. This is the monster clause. Okay, so beyond 2 lakhs also, and up to 10% of salary, basic plus DA, by the employer, and such that the EPF, NPS and superannuation contribution by the employer does not exceed 7.5 lakhs. Anything under this category up to 7.5 lakhs is going to be deductible from your total taxable income. Okay, so let's say your employer contribution to your EPF is 1 lakh. Let's say your employer contribution to the NPS is another 1 lakh, let us say. So that's 2 lakhs, and you have already put 50,000 as your own contribution for beyond 1.5 lakhs here. So that's 2.5 lakhs. You still have 5 lakhs of additional headroom. So my limited point here, Mr. Sahu, is that out of the 7.5 lakhs total, the best that most people end up using is about 2 lakhs or 2.5 lakhs or 3 lakhs or even 4 lakhs or 4.5 lakhs. But there's still another 2, 3, 4 lakhs available to take it up, top it up all the way to 7.5 lakhs. It's a function of your salary structure and what is being contributed to the employee provident fund or superannuation fund. But I'm sure you will find a few lakhs of benefit here. Like I said, the specific arithmetic depends on your salary structure and whether your employer has a superannuation fund that they are contributing to. Yeah, Pratibha. So I hope Mr. Sahu gets a clear answer.
Yes,
Okay.
yes, sir. It was very well explained. Yes. So we have come to an end.
Kunal, you want to make any last comments? I don't know whether Kunal is there online and whether he can hear us.
Sir, we can't hear you.
We can't hear you, Kunal. There's some problem with your audio. Maybe you can hear us, but we can't hear you. No, I think we've lost Kunal. Okay, never mind. So Pratibha, maybe we'll squeeze in one last question. We've caused a little bit of inconvenience right at the end. So,
okay.
Yeah.
Sure.
Tell me.
Give me a moment.
Sure.
Mr. Sanju Kundu is asking, so my age is 20 years, how to save tax? I invest in stock market, index fund, monthly SIP, PPF, 3,300 for 35 years and 1,000 for 30 years. I think he's trying to explain the breakdown he has made.
No, so we can't give specific arithmetical advice here, Mr. Kundu, to you, but my sincere advice is you're only 20 years old. I'm happy to see that you want to save more desperately than you want to spend, and that's a great sign. I wasn't this wise when I was 20. Okay. I wish I would have saved more. Not that I started earning when I was 20. I started earning only when I was like, what, 23 or something, or 24 maybe. So you got an early start in life, Kunduda. Okay. So what you should be doing is that you should be saving. Okay. And you should, of course, if you already have a taxable income, wow, you're doing very well in life. And you should put as much of your money as possible and avail of the entire ATC benefit. You should avail of that 50,000 benefit additionally, which you get from NPS. And of course, if you get a lot more income than what I think you are doing right now, then you should also be investing in the NPS and avail of that entire headroom all the way up to 7.5 lakhs. I think we'll close it at that.
Yes.
Okay, thank you. And have a great day, all of you. And also
Thank
on
you,
behalf of
everyone.
Kunal, yes, so Kunal unfortunately has an audio problem, but on behalf of Kunal, on behalf of myself, and of course the rest of the HDFC Securities family, have a great weekend. Happy investing. Remember to crack and hack all the 7 ways of tax saving and creating wealth in the long term, especially with the national pension system. Yes.